Down in this book, I'm not going to go into all the details. You can read this as well. But he breaks stocks into these categories, 6 categories: slow growers, stalwarts, fast growers, cyclicals, asset plays, turnarounds. You should read that. You don't have to agree with it. I don't entirely agree with those classifications, but it does play into his book and some of the descriptions of like what you should do with once you identify a company as one of those 6 plays. Why when you should buy and when you should sell based on what kind of category it is. I don't agree with the categories, but like the theory of it, I love it. I think that is such a great idea. And I always say, like, if I'm on a Discord, I'm talking to people, I'm like, okay, why? I will constantly be asking people, why did you buy this company? Like, what purpose was it? And to me, they don't understand. Like, it dates from my understanding of Peter Lynch. The entry, what do you expect to get out of this investment? How and what's the plan? And if you just say, well, the plan's to make money, I mean, I don't think you're going to be successful thinking that way, just in general. So the types of companies Peter Lynch looked for. Um, I mean, I don't know, I'm not him. He writes in his book, he looked for dull businesses, and he says it in numerous places. He didn't like to invest in what everyone else. He didn't what everyone else was talking about, whatever was the hot stock. He would avoid them like the plague. He wanted dull, boring, simple to understand businesses, which I've taken some of that in my investments. Like, I mean, I like retail, like Tractor Supply, Home Depot. I can understand these businesses, Caterpillar. So I take some of aspects of that from him, not all of it. So he liked dull businesses, low. Um, the disagreeable part, I think he was talking about like cigarette companies. He did like cigarette companies and spin-offs. So he liked small, boring, easy to understand companies that no one was talking about. That's what he would look for his investments. And like here, one section stocks he would avoid. He hated. He says it a lot. He would always avoid the hot stock if people give him tips on a stock. So as retail people on YouTube, I bet you can think of the modern day version of the hot stock, probably called the meme stock. Peter Lynch would probably avoid meme stocks like the plague. If they're talking about it, he's out of it. And I'm kind of the same way. Like I actively look for companies that no one knows about, and they're very interesting to me. Um, so yeah, so I take pieces of Peter Lynch. I don't follow everything that he says because this book is from the '80s. So take it for what it is. So he hated. Now, like I said, he liked simple businesses that did like one thing and they did it very well. He hated. He writes about it. He does not like when corporations, what he would call diversification, which was the idea of a large profitable company dedicating themselves to buying and becoming empire builders almost, because like to uh, easiest ways to make foolish acquisitions. And obviously, when you buy other companies, you're always overpaying. And then, like he says, completely beyond the realm of understanding, this insurance loss will be maximized. You can read it like he does not like when big companies start to acquire other companies and try and empire build beyond what their simple business was in the first place. He was not a fan of that. So he talks about PE, this part, if I could tell you one thing about this book, this is the one thing. If you could take anything away from this book, I think this is great. If you remember nothing else about PE ratios, well, before I get into this, so he talks about PE ratios were used as a screening tool for Peter Lynch in this book. So he would look for PE ratios of like companies, and he'd look at averages of peers and stuff like that. That's how he wrote about it. So his screening tool was PE ratio, not DCF models or some other metric. It's up to you to decide what kind of screening tool. My screening tool for an investment is I just do a quick overview of the financials, and I can kind of tell if I'm interested before I start to dive into actually like their filings and listen to their quarterlies and look at the presentations. I have an idea what I want to look for in a company. Um, so everyone's a little different. Um, But he says here, he avoid stocks with excessively high PE ratios. You'll save yourself a lot of grief and a lot of money if you do. With few exceptions, an extremely high PE ratio is a handicap to a stock. In the same way, extra weight on a horse. He's an old man. Give him cut him a break. A company with a high PE ratio must have incredible earnings to justify the high price that's been put on the stock. If anything I can give you, if you're looking at a company with a P ratio like 50, 60, 70, you need to understand this part. So it's priced to perfection. It has to hit those crazy earnings growth numbers or it's going to fall like crazy. Um, there's examples you can go look out there and it happens. And you find an amazing business, but everyone knows it's an amazing business. And then you see it's got this high PE ratio. Then you look to projections. A 60 PE ratio company is probably going to have projected growth of 30 to 40% per year. And if they don't hit that, you're out of luck on that investment. So you need to understand that part. Nobody said you had to get single digit PE ratio companies. That's not what he's saying. He's not talking about lower is not better, but excessively high is a problem. Um, So he and later on in the book, he talks about different types of companies. So he's got six categories of stocks, but then he also then goes into metrics like slow growers, stalwarts, fast growers, turnaround plays, asset plays, cyclical. This chapter you can read. Um, again, he goes into like why you would buy a company that of that type of that classification, and then why when would you sell it. I don't necessarily agree with those classifications, but you get the idea. He identifies a company, he classifies it based on his own classifications, and then that gives him an idea of what his expectation on that investment would be. Um, and you could just take you don't have to follow exactly what he did, but like just that concept, I think, is a good concept for picking stocks. Like I said, identify what is this investment to you? Why are you going to buy it? What do you think you're going to get out of it? And if it doesn't go the way you want, should you sell it, buy the dip? But you have a better understanding of what you're trying to get out of that company other than just making tendies. The report. So the part of the book he talks about financials. It's not. It's very brief. I mean, this is not a book about understanding how to read financial statements. Later on, I'll show a few that you could read. So he talks about looking at cash compared to long term debt. That's one repeated metric, or not a metric, but it's something I've noticed that he talks about comparing like the cash and equivalents, and then he looks at the long term debt of the business, which I do too. I think that's a good metric to look. You're looking at the actual cash value of the company almost. This just goes. He liked companies with steady and consistent cash flows and didn't have to do huge capital expenditures to produce those cash flows. So he talked about like he would prefer like Philip Morris McDonald's, more reliable cash flows without huge capital expenditures, unlike a steel company where they have a lot of expenditures with the furnaces and then they have to carry inventory and um, so he's more of a cash flow is king type guy when it comes to picking businesses, which would fall in line with his idea of smaller, simpler to understand companies, like a hotel chain or a retail store. Um, Near the end, of the book, he talks about like he identifies three phases of a growth company: startup phase, rapid expansion, and then there's the rapid expansion phase, then mature. So startup, rapid expansion, mature phase. Um, I do think about I don't really buy startups, so I don't think about that. But um, I've said before in pocket like companies are growth companies, and then someday they are not a growth company; they are a mature company. They're not in charge of that switch. Someday that switch gets turned. A lot of times the stock doesn't do too well in the short term when that happens, that changeover. But I would classify mature into into a few different phases because there's a difference between like McDonald's and IBM to me. So not all mature phase. So to be like, oh, I avoid all mature companies because they're boring, they're old, they're dying. I'm out. there are different, I would classify mature companies into multiple categories. Um, and you can still do very well with mature companies. And they're less volatile. So as you get older, if you buy some, rapidly growing companies as you're younger, so you could take risk and they're risky. When you get older, if they turn to a more mature company, now it kind of fits with your investment profile as you get older, which, like for me, like McDonald's, Lockheed Martin, I don't know if I would necessarily buy them like today as a starting position, but they're mature companies and they're still growing in different ways. They're not the same as a fast growing startup, but they give me stability that I like. Um, should you be buying mature companies when you're 20, 25? I mean, you could have some. I don't think you should go all into one type or the other. Um, and he talked in the book too. When he ran his fund, he would have companies of all different categories. He has a chapter on portfolio management. Bear in mind, I'm not going to talk about here because he's talking about Magellan's portfolio, not yours. It's not very relevant to you, but he did have investments across the entire spectrum of categories that he identified. So he was diverse in his investments. So in the near the end of the book, this is a really good chapter. Pay attention to this part too. It talks about the final checklist about before you've decided to buy a stock. So he talks about the different categories. He's already talked about slow growers, stalwarts, cyclicals, fast growers. What we've already talked about, and he's put like a checklist of what you should check. Once you identify it as that type of company, these are the type of metrics you should look at before you pull the trigger on this. He was obviously big on the fast growers. That's kind of what Magellan was doing. But he did say he did invest in companies of different businesses based on what he could identify. I think the turnaround. Now I'll probably do a video later on this. But turnaround plays are one of the hardest investments I think in investing for a retailer. Like it's so hard to get wrong the turnaround. You have to identify what the problem is with the company. Do you think they're going to actually solve what their problem is? Why is the company falling? Like Intel is losing market share to AMD like crazy right now. To have to understand Intel, then you have to understand why they're losing market share to like AMD. You have to figure out like how will they turn that around and then improve. It it's a hard investment, and it's one that should be not taken lightly for retail investors. And there's other companies I can think of. I don't want to get into right now, but it's a difficult investment, the turnaround play. And just because the stock dips doesn't mean it can't dip anymore. So, and then I had, and speaking of buying the dip, he talks in the end about things that people tell him that, here's the chapter, the 12 silliest things that people say to him. One of them was, if it's gone down this much already, it can't go much lower. And he's just like, there's no rule for how far a stock can go. Um, so the dip can keep dipping, and you think, oh, I'm just lowering my cost basis. Oh, if I loved it at 20, I'd love it at 10. There's no saying how far it can go down. And I've heard horror stories of retail traders getting just crushed by this. And I think they never just stop. And they didn't want to recognize that they made a mistake, I think is part of it. So they keep, instead of saying that you made a mistake, they just keep buying the dip. And I have investments right now that are down. I'm not buying them. Like I bought them at a certain range. They fall below that range. These are small speculative investments. I'm not buying more. So I'm just going to let it go, let it ride out, or I'll sell it. But to just keep buying the dip like that was your plan. That was not your plan when you bought it. You had an expectation on that investment, and it went the wrong way. And instead of analyzing what you did or taking a pause and just buy it at a lower price because of what, like you're just piling failure on top of failure. I don't understand that. There's no proof that that works. I think the proof actually is that you should cut your losses. That could be a video for later on for me, like buying the dip, the whole idea of that. I think it's something that would be worth discussing. So we'll see. But this is about Peter Lynch. So near the end of the book, he talks about options and stuff like that. whatever. Do what you want. I do options and now and again. It's not a big part of my investment process. So